Imagine two people. One starts investing at age 20 and puts away just $10 a day. The other waits until age 35 but invests twice as much. Who ends up richer? Surprisingly, the person who started earlier often wins by a lot. Why? Because of one of the most powerful forces in money and investing, compound interest. It's been called the eighth wonder of the world, and once you understand it, you'll see why so many ordinary people quietly become millionaires over time. In this video, we'll break down what compound interest actually is, how it works, why time matters more than talent, and how beginners can start using it today. Let's get into it. What is compound interest? Compound interest is simple. It's when your money earns returns, and then those returns start earning returns too. Think of it like a snowball rolling downhill. At first, it grows slowly. But as it gets bigger, it collects more snow faster and faster. Money works the same way. Let's say you invest $1,000 and earn a 10% return. After 1 year, you now have $1,100. In year 2, you don't just earn returns on the original $1,000. You earn returns on the full $1,100. So now, your money grows even faster. That's the magic. With simple interest, you only earn money on your original investment. With compound interest, you earn money on your original investment, your previous gains, and eventually the gains on those gains. Over long periods of time, this creates exponential growth. And exponential growth is where wealth is built. Why compound interest is so powerful. Here's where things get interesting. Most people think investing is about finding the perfect stock or getting rich quickly. But for most successful investors, the real secret is time. Let's look at an example. Investor A starts investing at age 20. They invest $300 per month until age 30, then stop completely. Total invested, about $36,000. Investor B waits until age 30 and invests $300 every month all the way until age 60. Total invested, about $108,000. So Investor B invested 3 times more money. But assuming both earned around 10% annually, Investor A can still end up with more money by retirement. Why? Because the early money had more time to compound. That's the key lesson. The earlier you start, the harder your money works for you. At first, compound growth feels slow. In the beginning, your investments might barely move. But after enough time, growth starts accelerating dramatically. This is why many investors see the biggest gains later in life, not because they suddenly became smarter, but because compounding finally reached escape velocity. The Rule of 72. Here's a quick trick investors use called the Rule of 72. It helps estimate how long it takes for your money to double. You simply divide 72 by your annual return rate. For example, at 6% returns, money doubles in about 12 years. At 8%, it doubles in 9 years. At 12%, it doubles in 6 years. This means small differences in return rates matter a lot over decades. But even more important than return rate is consistency. A decent return over a very long time usually beats chasing huge short-term gains. That's why many wealthy investors focus on long-term investing instead of trying to get rich overnight. Why most people miss out. So if compound interest is this powerful, why don't more people benefit from it? Usually for 3 reasons. First, they start too late. People often think they need a lot of money before investing. But compounding cares more about time than starting size. Even small amounts invested early can become surprisingly large later. Second, they interrupt the compounding. Every time you withdraw money early, panic sell, or constantly jump between investments, you slow down the process. Compound growth needs time and consistency. And third, they underestimate patience. We live in a world obsessed with fast results. But compounding is slow at first and dramatic later. Most people quit before the magic happens. How beginners can start using compound interest. The good news is you do not need to be rich to benefit from compound interest. Here are a few beginner-friendly ways to start. 1. Start immediately. Even tiny investments matter. Starting with $5 a day today is usually better than waiting years to invest larger amounts. 2. Invest consistently. Set up automatic investing if possible. Consistency is more important than timing the market. 3. Reinvest your earnings. Dividends, interest, and profits should stay invested whenever possible. That's what fuels compounding. 4. Think long-term. The biggest enemy of compound interest is impatience. The stock market goes up and down in the short term, but historically, it has grown over long periods. 5. Use tax-advantaged accounts. Retirement accounts and investment accounts with tax benefits help compounding work even faster because less money is lost to taxes. Here's the truth about building wealth. Most millionaires are not financial geniuses. They simply give compound interest enough time to work. The earlier you start, the more consistently you invest, and the longer you stay patient, the more powerful compounding becomes. And eventually, there comes a point where your investments start earning more money than you contribute yourself. That's when wealth creation really changes. So don't focus on getting rich next month. Focus on building a system that keeps growing for decades. Because compound interest is not just a math formula. It's time turning small actions into massive results. And the best time to start using it is today. If you enjoyed this video, hit like and subscribe for more beginner investing and personal finance content. And in the comments, let me know